Labor Day looms, and with it, a chance to celebrate again the strength and character of the American labor movement, a chance to pause to honor the contribution of American workers to the prosperity of the economy. But sadly, on this particular Labor Day, the one that's looming now, there's precious little to celebrate or honor on either of those fronts. For most American families, real wages have been falling now for a decade. And unemployment rates, of course, are unacceptably high. This is not a great time for American labor. But it would appear to be a great time to attack American labor, and that attack is well and truly underway. We've already seen this year very serious attempts to flush public sector unionism out of states like Ohio and Wisconsin. We're hearing now criticism of unions as Boeing tried to relocate some of their production facilities from one side of the country to the other. And that is always to be expected, because amongst American conservatives, trade unions invariably stand condemned for creating unemployment by raising wages. They are invariably condemned for creating inequality, for negotiating better wage rates for their members than non-unionized workers can negotiate for themselves, and they're invariably labeled as opponents of technological change and therefore huge disincentives to investment and productivity growth. So it's worth asking on this Labor Day whether the one institution in the United States that is centrally committed to raising American wages and improving American working conditions, namely the trade union, whether the trade union is in fact the cause of our present recession and the cause of its prolongation. I think the answer to that question has to be an unambiguous no. American labor did not cause this recession. American labor is not prolonging it. Sections of American capital caused this recession, and American capital is now making this recession last. The mass unemployment that surrounds us now is not a product of trade union power, it's a product of Wall Street excess. Low wages amongst non-unionized workers are not caused by trade unions. They're caused by things like right-to-work legislation and opposition to any attempt to raise the minimum wage. And the great barrier to investment in our present condition is not trade union power and pressure on corporate profits. On the contrary, trade unions are very weak right now. Corporate profits and cash holdings are high. Why those cash holdings are not coming back in the form of investment is a fear amongst senior managers that if they make commodities, they will not be able to sell them. Lack of demand is our problem right now. And lack of demand, of course, is rooted in low American wages, not in high ones. It is worth remembering that we have been through two great periods of prosperity and growth in the United States since the Second World War, in the first of which trade unions were strong, and in the second of which they most definitely were not. In the first period, from 1948 to 1973, trade union pressure kept productivity and wages rising together. It maintained high levels of internal demand, and it blocked off sweatshop routes to easy profitability. In that first period, blue-collar incomes rose, income inequality diminished. But in the second period, the one that began in the 1980s and came crashing down in 2008, the situation was otherwise. Trade unions were very weak, under heavy attack throughout that period. Wages for the vast majority of Americans stagnated, income inequality expanded dramatically, and people managed to raise their standards of living to the extent to which they did only by working longer and longer hours and by accumulating vast amounts of personal debt. It was that particular second growth period that culminated in the financial crisis of 2008, amid the rubble of which we are still now trying to survive. We are in pursuit of a third period of growth based on some deal between labor and capital. And the people are telling us that we need to reduce trade union power even further than it already is, are in effect saying that they want to recreate again the conditions that underpin the second period of growth. When in fact what we want to do, what we need to do, is to get to a much more stable period of growth, a modern version of the first one, based on strong manufacturing in the United States, strong trade unions, high American wages, and lots of good American jobs again. Now, racing to the bottom by chasing Chinese wages will not generate prosperity for the bulk of us. Giving tax cuts to the rich may make the rich richer, but it won't lift the rest of us up to generalized prosperity again. Trickle-down economics doesn't work. We need trickle-up economics. So it is really time on this Labor Day for the labor movement to begin again to reassert itself. We've been led, or rather misled, by corporate America for far too long. It genuinely is time for American labor to say enough.